catch up is our word of the day. And Bob, I know this comes up a lot with private real estate funds. It's a bit controversial, right? It's basically how the managers are judged. But what is it?
Right. It's a very important idea to understand for investors in private real estate funds in particular, but really all private equity kinds of funds. Everybody knows that the managers get that 2 and 20, right, or 1.5 and 20. The 20 being the management success fee. When they do well, they get 20% of the profits. So this is one of those terms that goes hand in hand with that. But you have to understand the devil is in the details when you calculate that 20%. And probably the biggest devil is the catch-up clause.
Okay, so the catch-up clause, take us through a little bit of the math just so we can see how it works.
Right. So here's what happens is, you typically have a private equity fund. It'll have 6, 10, 12 investments. It sells one. Gets proceeds as a result. So the first dollars that get allocated back to investors are their aliquot share of that. So if the investors put in $10 million to that particular investment, then $10 million comes back to them. And then on top of that, they get their so-called preferred return or hurdle rate. So this might be set at 6 or 8, seen as high as 12% lately. The investors that get that back next before the management gets anything. But now, it's time for the managers to get paid, and here comes the catch-up clause.
So basically, a manager can grab a big chunk of the percentage, right?
Right. So that's the thing. If he now says, oh, I get 20% of the profits, and you've got your capital back and your preferred return for that investment, now I get 20% of the profits. And he takes all the 20%. Well, in these days, sometimes there ain't a lot more than that. And so it can really hurt the investors' returns overall to have the manager jump in with a big catch-up clause at that point.
So what kinds of questions then should investors be asking? Should they say, how much are you going to make? Or, can an investor or rather a manager be that forthright?
Yes, absolutely. Investors should absolutely understand how this catch-up clause works. It really is important. 20% is fair if there's no catch-up clause. It's quite fair in a lot of cases. And that's what a lot of sophisticated real estate investors are demanding. No catch-up clause. I just want 20%. So after I get my preferred return back, then the next dollar goes 80 cents to me and 20 cents to you. You don't get all of your profit next. We start splitting 80-20 at that point. That's what sophisticated investors are demanding in these deals. And if you don't get that, at very least you want to have a clawback. So if they get to catch up, then you get to claw back in case they wind up with too much profit from that.
And are you finding with the structures out there that most that have the catch-up clause also have the clawback without having to go and
most of the time,
sue,
most of the time they do. And what's even better, frankly, is something called a European waterfall. We've talked about it once before. We might talk about it again, because that solves this entire problem, because the investors get all their money back from all of the deals before the manager gets anything.
Which does sound like a little bit more straightforward, clearer, at least easier to understand.
It absolutely is. So that's called a European waterfall. The American waterfall is where the investors get their dollars back on a deal-by-deal basis.